You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome. If you feel like the financial world is just spinning incredibly fast right now, you're definitely not alone. It feels like we've hit this point where fintech isn't just, getting small updates. It's like the whole structure is being rewritten. We're seeing these huge global mergers, buyouts designed to get total control. And then there's this quiet rise of software agents doing actual work. It's all happening at once. So our mission today is really to give you the shortcut through all that. We want to quickly unpack the biggest strategic plays shaping things. Think of it like a triple threat that's changing banking and commerce, AI becoming this core operating system, this intense global race for banking licenses, and crypto finally getting woven into everyday transactions.
Yeah, and what's really striking when you look at all the information coming out is you see these clear patterns emerging. It's deliberate. This isn't just random growth or, hype. It's a calculated push by the big, mature fintech players to kind of shed their old dependencies. They want to own the whole value chain themselves, trading reliance for control, basically. And you can see the regulators are scrambling a bit to keep pace with where the tech is going.
Okay, let's unpack that first one then. AI in finance. The really big shift isn't the chatbot you talk to on a website, is it? The game changer seems to be AI becoming this invisible engine underneath everything, the work layer, driving core processes behind the scenes.
Exactly. That's the key difference. It's moving beyond being just a helpful co-pilot suggesting things to a person. It's becoming an autonomous agent that actually does critical tasks. And for founders or investors, the big question now is, are you selling AI tools to others, or are you using this sort of hidden AI to rebuild your own operations from the ground up, quietly disrupting your industry?
And that second path, using it yourself, seems incredibly high stakes.
Especially in fraud prevention, right? Like Ramp, they focused on corporate spending. They rolled out AI agents specifically to scan invoices and payment data before money goes out the door. And the results are kind of nuts. In just a 90-day test, these things flagged over $1 million in fake invoices. We're talking one blockchain company almost lost $50,000. That got caught. That's not just a helpful suggestion. That's serious money saved by automation.
Right, and that shows the strategic power. Then you look at something like Intercom's FinAI agent used by Moneybox, checkout.com. That's the other model, selling the AI capability. They built it for regulated financial support, and it's apparently handling 70% of support tickets by itself. That standardizes efficiency across the board.
Yeah, and you can see how that kind of efficiency puts pressure on the big traditional players. Bank of America, they moved slower, but they had to react. They built their own internal AI assistant, Ask GPS.
Ask GPS, right. Trained it on tons of internal docs. And apparently, it cuts down the time to answer complex internal questions from an hour to just seconds.
Wow.
So that's the internal pressure forcing the big guys to adopt that fintech speed. It's that new work layer in action.
And that efficiency you just mentioned, that's the fuel, really, for the next big strategic play, this global race for banking charters. The second these fintechs figure out they can run their core stuff cheaper and faster than a traditional bank, well, the whole equation changes.
Okay, so they realize, wait, why are we paying this sponsor back?
Exactly. Why depend on them when we can be the bank? They want the keys to the regulatory castle.
It's the ultimate vertical integration move.
Totally. And you see the neobanks that conquered markets outside the U.S. now making a serious play here. Look at Nubank.
Huge in Latin America, right? 120 million customers or something?
122 million, yeah. Brazil, Mexico, Colombia. And now they've filed for a U.S. banking charter with the OCC.
Okay, hold on. OCC, that's the Office of the Controller of the Currency. That's the big leagues for U.S. banking regulation.
Gold standard.
But getting that charter, that's notoriously difficult, isn't it?
Yeah.
I remember Bunk, Revolut, Monzo. Their U.S. applications kind of stalled out or got pulled.
Oh, it's brutal. The compliance investment is massive. But think about the payoff if Nubank gets it. They could offer deposits, cards, lending, maybe even crypto custody here, completely cutting out U.S. partner banks.
Yeah, that freedom probably justifies the pain of getting the charter.
And it's not just the consumer neobanks chasing this. Payment platforms are doing it too. Checkout.com applied for a special Georgia charter.
Georgia's Merchant Acquirer Limited Purpose Bank Charter. Okay, what does that specific charter unlock? Why that one?
It's a special one. If they get it, they join just Feedzai and Stripe in having it.
Wow, only 2 others.
Yeah, and structurally, it lets them cut out the traditional bank middlemen in payment processing.
Okay, so direct cost savings.
Direct cost savings, more control over risk, and faster product development because they're not waiting on a partner bank. And if you zoom out, the fact there have been like 20 bank charter applications filed this year, that's an all-time high.
Right.
It tells you that for these scaled fintechs, the huge cost of compliance is now seen as worth it to ditch the sponsor banks.
Right. And this drive for control, it's also fueling consolidation, isn't it? Like the Gusto deal. They bought Guideline, a profitable 401k provider with, what, $140 million in annual revenue?
Yeah, ARR. Pretty substantial.
But then Gusto says they plan to get rid of Guideline accounts linked to rival payroll companies like ADP or Rippling. That seems aggressive. Why buy a company and then immediately plan to shed customers using competitors?
Because it's not just about adding a feature. It's about consolidating the customer's entire financial life into the Gusto world. The strategy is, if you use Gusto for payroll, you have to use Gusto for retirement, benefits, maybe even banking down the line.
Building a walled garden.
Exactly. Vertical control means kicking out anything that connects your customer to a competitor. It's ruthless, but strategically, it makes sense for them.
Okay, shifting gears a bit. The third big force here is digital assets. Crypto. It feels like we're watching it stop being just this niche investment thing and actually become part of the plumbing for everyday commerce.
Yeah, the infrastructure seems finally ready for, like, mainstream use. Look at these super apps emerging. OnePay, the fintech backed by Walmart, is putting crypto right into its banking app. Buy, sell, hold Bitcoin and Ether via Zero Ash.
And OnePay is already doing pretty well in the app stores, right? So they're a real contender against PayPal Cash App. Putting crypto next to your checking balance like that, that's a big step for making it feel normal.
And making it easy is crucial for people to actually use it. Coinbase just did something interesting there, too. They launched a peer-to-peer thing. You can send USDC stablecoin instantly for free, just using a phone number or email.
Instantly and free.
Yeah, and they give you, like, 20 free transfers a month using Base, their Layer 2 network.
Okay, why is Base important there? For listeners maybe not tracking Layer 2s, why does that detail matter for sending money easily?
Great question. So Base is Coinbase's own Layer 2 scaling solution for Ethereum. Using Layer 2 means the transactions happen off the main Ethereum chain, which can get slow and expensive. So Base makes it super fast and way, way cheaper, like pennies, or in this case, free for those first 20.
Got it. So that removes the friction. Makes it practical.
Exactly. It shows Coinbase shifting from just being a place to trade crypto to being more like a full financial utility.
I think the most potent integration, though, might be Square connecting it to local businesses. They launched Bitcoin payments and Bitcoin conversions. And the detail that jumped out was sellers can accept Bitcoin with zero processing fees.
Zero.
Hold on, zero processing fees. How does Square make money there? Is that just a loss leader to get businesses using Bitcoin? That sounds unsustainable?
It's a bit of both, but it's partly just the nature of Bitcoin itself. The network fees on Bitcoin are inherently way lower than the 2-3% interchange fees from Visa or MasterCard. So Square can pass on those savings. It's definitely a strategic move, a massive lure for small businesses sick of card fees. But the underlying cost structure kind of supports it. It's potentially a huge shift for small business payments.
Right. Escaping those legacy fees.
And thinking bigger picture, this all touches on how banking itself might be restructuring. There's this quiet trend towards something called narrow banking. Traditionally, banks mix safe deposit taking with risky lending. Narrow banking suggests splitting those. Deposit taking would only be backed by ultra-safe stuff like government bills. And the riskier lending moves outside the bank, maybe to private credit funds.
And stablecoins fit neatly into that model, don't they, as the safe deposit part?
Precisely. Stablecoins are kind of emerging as the new narrow banks. They issued digital dollars like USDC, backed fully by safe, liquid assets. They're structurally forcing that separation between safety deposits and risk lending, which could, arguably, make the whole system more stable by unbundling those functions.
So wrapping this up, what does this all mean for you trying to follow the fintech space? We've talked about AI agents becoming this core operational layer, saving millions on fraud. We've seen scaled fintechs ditching partners to become banks themselves, chasing total control. And digital assets are becoming standard payment rails, from super apps to the corner store. The result isn't just small changes. It feels like a forceful vertical integration, a real rewriting of how money moves. It's the kind of thing we try to track here on Vocal Technologists.
Yeah, and maybe a final thought to leave you with on this structural shift. Jeff Bezos apparently made this interesting distinction recently between financial bubbles and industrial bubbles.
Okay.
He argued financial bubbles like 2008 just leave wreckage behind. But industrial booms, think the internet or maybe this current AI wave, they create lasting, useful infrastructure, even if the crazy valuations pop eventually.
Interesting distinction.
So his point is, your focus should be on what's actually useful long-term, regardless of the market hype right now. The actual utility of AI stopping fraud automatically, the real cost savings from getting a bank charter, the zero fees on a stablecoin payment, that utility is real. That's the infrastructure being built that will likely stick around and reshape things for years. That's maybe what you should really watch.
Focus on the enduring utility. This is really solid advice. Take this knowledge, apply it, and we'll catch you next time.
Spoken Tech for your ears.